Hi, welcome back to another edition of Lippers Fund Flows Insight. My name's Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the week ended April 1st, 2015. We're a little bit late. We were closed on, as the market was closed, we were closed on Friday in observance of Good Friday. And also on Monday we had some reports out, so we're running a little bit behind, but we still wanted to give you guys a rundown of what happened in the flows for the prior week. And basically we saw about $33 billion in outflows for the conventional fund business, a pretty big number. And this was just on discouraging news out of Yemen. There was the military strike. Also, there is this kind of dour, sour mood in the market right now with people thinking that Q1 earnings season is going to be poor. Well, we'll have to wait to start to see what happens. Tomorrow, actually, we get our first glimpse at Alcoa coming out. I know they're no longer the big industry darling that everybody watches, but certainly people's eyes will be on that. And also we heard that the ISM numbers came out lower than expected, and so there was a drop that we had to contend with. Nonetheless, though, we also saw that in the Chinese market, they hit 7-year highs as far as their returns go. A lot of people call that speculation. A lot of people said that was because the People's Bank of China actually said, hey, we're willing to do some more economic easing if the economy looks to be too soft, and then we'll build that back up. So I think that was encouraging from that point of view. Let's go ahead and take a look at how they actually broke out to our macro groups and how this translated into flows. Equity funds saw about $4 billion in outflows. Taxable bond funds did take some money in, about $1.8 billion. We saw muni bond funds actually lose some money. This is the first in about 13 weeks. About $400 million in outflows for that group. And then money market funds saw the lion's share of people taking money out. Not too unusual at the quarter end, people putting money to work in different areas. So about $30.4 billion in outflows. And, again, that's not too unusual. Let's take a look at how this translates, though, at a macro level. So let's take a look at equity funds at first, and we'll give you a little more detail on that. Actually, we saw positive returns, about 0.06% return. Nothing, but at least it was on the positive side. But the second week in 3 that we've actually seen that it was plus side returns, but it's the second consecutive week we've actually seen outflows. About $1 billion left the coffers of equity funds. And how this broke out is we saw domestic equity funds was about $3 billion, and this is the 9th consecutive week they've seen outflows. And non-domestic equity funds saw about $1 billion now. This is the first week in 8 that they've actually seen outflows. Interesting enough, if we take a look, though, in detail, large cap funds actually saw a lion's share of outflows. So not too surprising there, about $2 billion in outflows. But then we take a look at something that's been pretty popular, equity income funds. They lost about $700 million in outflows. So that was a little bit of a head scratcher, but that obviously made up for the lion's share of outflows from the domestic equity side. If we take a look, though, at the global side, non-domestic, international equity funds saw their big outflows, and it's kind of unusual considering what's been happening in Germany and the like, but $900 million in outflows there. But interesting enough, if we take a look at emerging market Pacific, ex-Japan and Pacific region funds, they saw about $500 million of net money come into their coffers. And believe it or not, emerging markets, this probably has to do with the China issue that I was just talking about. China actually, in emerging markets, saw about $400 million net new money come into their coffers. Not a big story, but again, what a tale of two cities. If you take a look at domestic and then non-domestic, and then break down non-domestic into emerging market and developed markets, certainly the emerging markets actually took in most of the money this time. Let's see how this translated into ETF flows now, though. For the first week in 3, we saw pretty big outflows, $7.2 billion in outflows. The Russell 2000 ETF actually saw the largest in inflows, about $1 billion. And then if we take a look at iShares U.S. Energy ETF, and again, the Yemen military strike caused a jump in natural resources, and particularly in the oil area, and the reason is people thought there would be a shortage on that. So the U.S. Energy ETF saw about $900 million of net new money coming to their group. On the flip side, look at the bottom, S&P 500 saw the big lion's share of outflows, $10.5 billion in outflows, and then PowerShares QQQ saw about $1.4 billion in outflows. So really stayed in tune. Retail investors and authorized participants certainly were bailing on a lot of the local equities. Let's take a look how this translated again into fixed income flows. Fixed income funds for the 13th consecutive week saw inflows about $1.8 billion. It's the second week in 3. They've actually had plus side returns about 0.14%. Not a lot to talk about. But we saw a change in leadership here. Flexible portfolio funds, $1.8 billion, 10th consecutive week that they've seen money come into their group. And corporate investment grade debt funds only saw about $500 million of net new money come into theirs. And it's possibly because we saw, and this is the 13th consecutive week they've seen money, it's possibly because we saw loan participation funds actually lose some money as well, about $400 million, third consecutive week they've seen outflows as well. Now, if we take a look now at the ETF side of the business, it kind of stays about in the same pattern. We saw for ETFs that about $700 million was an inflow. It's the third consecutive week they've seen inflows. The iShares 7 to 10 Treasury bond ETF took in about $260 million, and the iShare iBox high yield corporate ETF saw about $260 million in net inflows as well. So that left us with who's at the bottom. PIMCO short maturity active ETF fund saw about $190 million in outflow, almost nothing as far as comparative goes with that case. And then that would bring us to our muni bond funds, and this is where we've had a little bit of change of pace. And we talked about that this morning, and actually over the weekend we were trying to look at who was the culprit. Well, a lot of times when we see weekly flows, change in weekly flows, it can be just noise. It can be a big institutional client pulling out money and that kind of stuff. Well, this time what we saw is muni funds lose about $373 million. It's the first week in 13 that they've actually seen outflows. It's the third consecutive week, however, that they've actually had plus side returns, this time to the tune of 0.12%. And the big culprit this time, no surprise here, national munis saw about $338 million in outflows. It's the first week in 23 that national munis have actually seen outflows. So this was a little bit of change. So again, whether it was a big institutional client pulling money out, or whether this had to do with some other reason, we can't really put our finger on what the cause was, and we'll have to look at this next upcoming week to see if there's any change in pace. Let's take a look at our last group, and that's money market funds. Money market funds for the second week in 3 saw outflows. This is $30.4 billion. If we broke this down, taxable money market funds saw about $28.5 billion in outflows, while the tax-exempt money market funds saw about $1.9 billion in outflows. On the money market side, though, taxable, institutional investors were the cause of all the outflows, $28.4 billion. That's what makes us believe that this might be just big investors or corporate clients actually moving the money around right at the end of the quarter. $28.4 billion in outflows versus on the retail side only 0.1 or $100 million in outflows, almost a non-story. Well, that brings us to the end of this conversation, and basically what I thought I would do is kind of go over what's happening, some of the news that we've heard here recently. Basically, we saw that non-farm payrolls came in much lower than expected, at about around 126. I think the market expected almost twice that much. We also know that they redid the numbers for February, knocked those down, so that might be a little bit discouraging. Actually, in the market today, hasn't been all that bad for the market, but it's something we're going to keep an eye on, because as we get into the reporting season, again, starting tomorrow on Wednesday, Alcoa, basically jump-starts the Q1 reporting season. Also, with the idea that we had lower non-farm payroll numbers, that could take a two-sided coin here. I mean, one side of the coin says, people will be relieved because now the Fed isn't going to raise interest rates anytime soon. The other side says, hey, listen, the economy is not as briskly responding as we thought it was, and that's disappointing as too. So we'll have to see how the market interprets that. Well, if you want to do a deeper dive, check into some of the classifications I've not covered today. You can go to www.lipperusfundflows.com and click on the areas that you want to do a deeper dive in. If not, you can join us next week, where one of our analysts will talk to you about the flows trends for that particular period. Well, until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.